Good morning. It's Marc Ostwald from ADMISI. I'd like to share a few thoughts on Canada and the Eurozone, which both have interest rate meetings next week, and a little bit on oil because, above all with Canada, oil prices are quite material. As we can see from this table, markets have basically been pricing in for a considerable period of time that the Bank of Canada will follow the Fed in hiking rates next week. It's about the only major central bank which is following the Fed at the moment. But what is going on in the background? Certainly, the fact that the NAFTA agreement has been changed into the USMCA is a positive for Canada. But what exactly is going on with perhaps one of its key engines of growth, the oil sector? If we have a look at the next chart, which is the oil price, and we're all speculating at the moment what exactly is going to be going on with oil in the short term. It's still in a long-term uptrend, which has been there, despite the very sharp drop that we've seen over the past week or so. There is a key debate here with oil about what is more important in the very short term. Is it really the supply side, where we have questions about the impact of sanctions on Iran, and on the other side, whether the oil sector as a whole actually has the ability to up output to make up for any fall that there is in terms of output from Iran, along with the ongoing situations that we've got, say, in Venezuela or in Angola. But in the longer run, I would still suggest it's the demand side, which people in the oil markets, economists, generally everybody is not very good at forecasting, which is going to be key. And obviously at this particular moment in time, we have quite a lot of doubts about the global oil outlook. But how does that play into Canada? I think if we have a look at the next table, which is a table of oil prices in North America. On the left-hand side, you can see the various prices for the various grades of American oil. One can see the discount that's there for Midland relative to WTI due to capacity constraints. But looking at the top right-hand corner of that table, we have a look at WCS, which is the Canadian West Canada select measure, which is their equivalent of WTI, and we see it is trading at a whopping $46 discount to WTI. And this plays into that story about capacity constraints. The fact of the matter is with the oil sector, and it's something which I think will play out more importantly as we go forward, is there's been little upstream investment and very little downstream investment since we had the big oil price crash. And now we're probably actually going to start having to pay for that. So when we talk about the capacity to up output, we also have to consider that existing output will probably start to tail away as some of the oil fields start to mature. And on the other hand, we'll see capacity constraints come into play as they have in Canada, where the big problematic is not necessarily that output is low in Canada, but the fact that there's actually no capability of delivering it to the United States, who would be the biggest export destination. So how does that actually play into the outlook for Canadian growth? Well, it remains to be seen. The Bank of Canada at the moment seems to be saying that overall non-energy business investment is quite strong, and therefore it's justified in keeping up with the US in terms of interest rates. But we shall have to see how that actually plays out. Now, of course, we also have Eurozone or the ECB rate meeting next week. No one's expecting anything particular from that, and I think perhaps the most notable intervention that we've had this week has been from new ECB Governor Olli Rehn, who used to be part of the European Commission and is now on the ECB board. Yesterday, hinting that basically suggesting that he was looking for a first ECB rate hike not in Q3 of next year, but in Q4, and he said, but adding the caveat that he wasn't very sure about that. It was very much contingent on the growth outlook. Obviously, what happens with oil prices will be material, but more importantly, obviously, what goes on in terms of the politics and the various budgets in the Eurozone. Our focal point at the moment is obviously Italy. So let's have a look at spreads between Italy and indeed the rest of the Eurozone and Germany. As we can see, we've pushed increasingly wider, and the fact that the European Commission has sent a letter to the new Italian government objecting to their new budget means that there is a big clinch coming on. Italy is playing an interesting card now, not only saying that it's not going to revise its budget, but also suggesting that the European Commission should also be sending letters to France, notably, who yesterday we had the interesting intervention from Mr. Macron saying it's not up to us to tell the Italians how to run their budget, which was an interesting pullback relative to some other governments, particularly Germany and Austria have been objecting quite strongly to Italy not adhering to Growth and Stability Pact rules. But he was also Mr. Conte, the Italian Prime Minister, was also suggesting letters need to be sent to Spain and Portugal. And as much as our focal point is Italy, it is well worth noting that the spreads in Spain have widened out quite considerably, not just in sympathy with Italy, but due to the fact that we had the court ruling yesterday that suggested that confirmed that the Spanish banking sector is on the hook for all the stamp duty on the mortgages which have defaulted, and that the bill for the Spanish banks could be in the realm of 10 to 20 billion euros. So we are back in a situation with the Eurozone where perhaps Mr. Rein's intervention yesterday suggesting that we may be pushing back on ECB rate hike expectations, let alone any discussion about the end of QE at the end of December, which will obviously be the key focal point for the ECB meeting next week, precisely because we might be wandering into another form of crisis, notwithstanding what is going on with Brexit negotiations.